Good afternoon, ladies and gentlemen. Yeah, as Mr. Albanese said, I stopped getting invited to conferences because I was regularly giving everyone bad news. In fact, the CEO of S&P, yeah, I have, as you'll see in a minute. In fact, the CEO of S&P phoned me one day and asked me to stop depressing our clients. And as I was employed to tell people exactly what was in the database, it was somewhat difficult. Anyway, the topic for this 45-minute discussion is securing the future, vital trends in exploration and development. And I'd like to start with some slides, just to set the scene. This is probably a table you've not seen quite like in this form before. I take the liberty of putting everything in the same units. So those of you that buy diamonds by the ton, currently paying 535 million. But the serious side of this slide, this is last year's production of metals at best guess at the moment and the actual average prices. So that far right-hand column is the amount, the mined value. And the point of this, for those that are not aware of it, is just to point out how dominating coal still is. I know it's going south, it's clearly going south, but it starts from absolutely domination. About a third of all equipment in the industry is bought by coal mines. The other important part of this slide, before we get too carried away with cobalt and lithium and the like, as important as they are, is the three most important metals absolutely dominate. The industry is all about those three metals. That's why the big companies, as Mr. Albanese will allude to, are about those metals. Massive percentage of wealth and staff, for example. These slides, incidentally, are all available if anyone wants them. Again, this will come as no surprise to anyone in this audience, I presume. A 10-year plot of the three most important mined metals last year. Obviously, big decline, as we all know, until January 2016, and quite clear improvements since then, albeit from a low base. This is in nominal terms, for which we're constantly criticised by not putting it in real terms. For anyone interested, I have a plot of real terms of the gold price back to 1270. We can do that in this country because we have inflation back then. I don't know quite how the Bank of England works out inflation in 1270, but it's an utterly fantastic graph. More seriously, one of the things S&P does, of course, is plot all the reported announcements. And the usual caveat, this is as reported. It doesn't necessarily actual numbers, because a lot of companies don't tell us what they're doing, particularly in China and India. But as reported to the world's stock exchanges, which we monitor in real time, that's the quarterly plot of drilling activity by projects announcing assay results. And you'll see there, disappointing March quarter last year, big increase throughout last year, a decline again in the first quarter of this year. That's not unusual. The last 5 quarters, first quarters have been down, as you can see, but we are back to the drilling levels of 2012. That's quarterly financing. I won't dwell on these. We do a quarterly report that I'd happily make available to you. The important thing of that is 10 billion was raised in the March quarter. It's back to the year ago quarter. Big improvement on the last quarter of last year. But the takeaway from that is very little being raised by the small companies. 60% of what's raised, we know where it's spent. That's a graph showing where it's spent. Not surprisingly, most of it in Canada and Australia. But the big thing to note there, and again, you have to look at it at your leisure later, but Latin America raised more was raised for exploration in Latin America in the March quarter than all of last year. This is my favourite graph. It puts everything in one place, really. The blue line is an index of the 8 most important metals, weighted by exploration expenditure. The red line is a slightly nebulous statistical thing we do on exploration and development activity. Broadly speaking, follows metal prices, which is heavily influenced by gold. But the important one is the bar chart. That's 2,500 listed companies. We measure it actually all the time, but there's a report goes out every month. This is at the end of every quarter. We peaked at $2.3 trillion at the start of 2011. third of that by January 2016. We'd recovered to 1.5 trillion at the end of last year and slipped again a little bit in the March quarter. Before you all get carried away about 1.5 trillion and how we're on the boom, just a reminder that the entire mining industry is valued the same as Apple plus Google. And this is from my colleagues at S&P Global Ratings. As you'll see there, not one mining company at the end of last year was rated better than A+. And that's improving. That's a plot of the net bias or the net outlook from S&P Global Ratings. And you can see there clear improvement over the last couple of years. And they reckon we're going to be modestly positive this year. However, S&P is calling that most mining companies are in a period of financial prudence. And so we're not expecting any great dipping into reserves. Right, that's it from me. And now we'll turn to our two panelists. We have Mark Rakovides, nearest me on my right, President of Euromines. Mr. Rakovides is the first person to serve a third term as President of Euromines, which is recognised as the representative body of the European metals and minerals mining industry. He's also Chairman of Euromines Gold Group. Mr. Rakovides, who is an MA from Oxford University, has been involved with a number of mining companies and natural resource projects, both as a financier and director over the past 25 years. His prior appointments included Chairman of Diva Gold in Romania, Executive Vice President of European Goldfields, Vice Chairman of Hellas Gold, and Vice President Europe at Dundee Resources. He also spent 11 years at the European Bank for Reconstruction and Development, which is where I first met him. On the far right, Ben Pullinger, Senior Vice President Geology for Exelon Resources, a professional geologist with an honours degree from the University of Johannesburg. Mr. Pullinger brings over 12 years of experience in advancing projects from early stage exploration through to production. His input has included marketing, financing, planning and execution. Most recently, Mr. Pullinger was Vice President Exploration at Rox Gold Inc., where he made a significant contribution towards bringing the Yaramoko project in Burkina Faso into production. In addition, Mr. Pullinger is responsible for discovery of the high-grade QV and QV1 gold resources. Our panellist has extensive international experience in Asia, North and South America, and Africa. Perhaps I can start by asking both panellists, as we saw from the slides I've just presented, we're clearly on a rising metal prices. Do they think that the current price recovery is sustainable? I'm clicking the glass. Would you like to start, Mark?
Yep. Thank you, Chris. Good afternoon, ladies and gentlemen. Looking at Chris's slides, I'm reminded by a lot of slides I see in our work with the European Commission and some of the member states, and you see the same patterns repeating themselves, and you can just fill in the data set. I have in my hand what's called the Raw Materials Scoreboard. This is a draft document. This is produced by the European Commission and circulated freely among the member states every year. This is draft version, but very happily the European Commission and various other people, including Chris's institution, have done all this work for me, so thank you. But the answer is very simple. In terms of population, the world adds one Germany every year. One Germany. In 2050, there's going to be 9.7 billion people, assuming just the current rate of growth. We're looking at increased urbanization. We're looking at increased economic aspiration. We're looking at lots and lots of people in lots and lots of countries rising from relative levels of poverty into middle classes. So at the same time, we're looking at a world that's changing in terms of response to climate change. Much has been made throughout today and yesterday, I'm sure, about electric vehicles. But the reality is not only electric vehicles, it's about renewable energy, the decarbonization, and the need for metals and other components to that. So I can only see one outcome. Yes, there's a very good study, by the way, that's just been published by the Austrian government. It's freely available on the internet, and it's called World Mining Data 2018. World Mining Data 2018. It's freely available on the internet. Just do a Google search on that, and you can find an extraordinary amount of raw data, which I'm sure he's already read. But the issues are very simple. Geologically, I beg your pardon, we do not have a shortage of resources. The issue is demand is burgeoning. Demand is rising exponentially. So the equation is very simple. I see prices only rising.
I think Mark put that very well and answered that question in great detail. I think one of the things that's important as well, though, is to acknowledge that not all commodities are created equally. I think this has been a great, in my experience here over this conference, has been a great indication of the enthusiasm and the excitement around some of these battery chain metals, some of the newer metals that are coming into the space. Copper in particular has taken a real center stage here, but there hasn't been a lot of talk really about what's happening with gold and silver, which are the two traditional stalwarts. And I think that when you have to look at those and break them up, I think commodity prices are going to rise. I think we're seeing increased demand on the battery chain stuff, on copper and stuff. But I don't feel, being stuck in the middle of this current gold and silver cycle, that I feel confident about whether it's going up or down. Again, though, when you look at these cycles, they're very long term, they're very drawn out, and a lot of the work that I've seen here is talking about longer, more sustainable cycles, which I think inevitably is better for the mining industry. But all that data to one side, just looking at the average cost of the industry, the cost to replace an ounce, the cost to bring mines into production, for this industry to remain sustainable, the prices have to go up in order just for us to keep on replacing, keep on building, and keep on mining.
I think most of us can agree on that, well, certainly in this audience. The thing that concerns me, and to put it into context, I've been in the mining industry for 40 years, and I graduated just when metal prices in real terms were at a high. So for the first 20 years of my career, we were in a bear market for most metals. And I was fortunate, I'm a mining engineer, and I had a fairly stable job. Quite a lot of my colleagues and children of colleagues haven't been so lucky. And one of my concerns, and has been ever since I was the editor of Mining Journal, is the industry has very serious cycles, and notwithstanding the fact metal price might carry on going up, I think those cycles have serious long-term implications for financing the industry and on the recruitment and retention of decent staff. Do you think that's an issue, or, I mean, am I wrong? And is there anything companies can do to mitigate what is a horrible series of cycles? Difficult question, I appreciate. Mark, do you want to have a go?
Yeah, I'm not sure it's entirely a question for companies. I think it might have been a question for companies 10 years ago. I'm not sure it's also a question only for investments. I think it is what I do, I accept, but I think it's also now increasingly a question for governments, a question for politics. There is an increased awareness of importance of security of supply. Concepts as described as critical raw materials, critical materials list in the United States also. So there's increasing political awareness of the effect of cyclical markets and cyclical supply. I think that's not spoken from a particular standpoint. I think the Chinese also take that view. I think increasingly you see that across the world and across political beliefs. So I think that we are increasingly seeing investment by governments, investment alongside governments, but more importantly, investment in capacity, both in terms of knowledge and people, research, development, innovation, in order to moderate and protect against the effects of cycles in supply and prices. So I think, yes, I think, cycles arise for different reasons in different circumstances, but I think their effects we are far more acutely aware of their effects, and I think those effects are being mitigated very strongly by political action. So I'm slightly hesitant to respond directly to what you said.
Ben, does Exelon retain their skilled staff in bear markets?
So as Mark was answering, I was busy contemplating kind of my experience in the business. And one of the things when you come to this conference, you get an opportunity to examine the demographics of what's happening in the mining industry right now, especially when you go to PDAC, which is a big conference in Canada. And I feel like the cycles have really hurt the industry's ability to maintain intellectual knowledge, talented people, and especially from the nature of our work. I've spent more than half of my career away from home, in the field, living in non-ideal situations, non-ideal locations. When I started, we didn't have communications and stuff on site. It's a difficult environment. So you factor that into cyclical nature and the ability to then continue to fund projects and have people out there. I think it does become very difficult during a bear market to keep everybody happy and keep everybody employed. And I think the long-term effects of the last couple of bull cycles in the post-BRIEX world are impacting the market today.
I have to say I couldn't get either of my sons into the mining industry, but it's a related question, because one of the other things we do is look at cash holdings, and that is the one area I'm still depressing people, I'm afraid. We looked at 470 mining companies listed on the Vancouver Exchange, and their cash holdings have increased lately, but they're still average only $1.5 million. There's a hell of a lot of houses in London worth more than that, but the average mining company in Vancouver doesn't have that in their holdings. So I perceive a serious ongoing shortage of cash in about half the industry. There's 3,000 odd companies in the mining industry. Half of them have cash holdings of certainly under 1.5 million. What do you think companies can do to appeal to a new category of investor, or don't they exist? Do you want to start first, Ben, because you know that? Sure. Looking.
I think that's a very, very difficult question. I think investors are faced with so many more opportunities of where to put their capital today, and I think things like blockchain and Bitcoin and marijuana in Canada have created a very different kind of risk-reward profile that you used to only be able to get from the mining industry, from the commodity industry. The excitement of a new discovery, following something into production, and then it's no secret that over the last 5 or 6 or 7 years, mining companies have had a very difficult time delivering on the promises that they've made as an industry. So I think that scared a lot of investors as well, especially with the cyclical nature of the commodities. People's money have gone elsewhere. What I find really interesting is the amount of specialist money now that's coming back into space. And we saw it in yesterday's panel when Orion and Franco-Nevada were talking about what they do to deploy capital. And someone asked the question, I think Rod had asked the question, what differentiates equity from the royalties and the streamers, the equity investor from the royalties and the streamers, and they both categorically said it's the ability to do due diligence, the ability to make sure that only the projects that should move forward, that they're financed, that people understand that mining is difficult and things don't always go according to plan, but that there is a plan and a plan B and sometimes a plan C to make sure that the projects that deserve to make it through all those hurdles, and there are a lot of hurdles on projects these days, actually make it there. And that, I think, is the way that we attract capital. I think it's important that the mining industry continues to self-fund itself as much as possible, because it is difficult. Mining is difficult, and you need people that understand geological risk, structural complexity, and political risk in the environment that we have to operate in, and then continue to fund it. But when we get that, I think you'll see more people coming back into the space, and hopefully commodity cycles turn around. You'll see that too.
Yeah, I've got to, sorry Mark, I'll just interrupt that. I've got an anecdote, because I gave a presentation to Mines and Money in Hong Kong several years ago, and we did a mining insight, which is explaining mining to non-miners. And I think I had 100 Chinese financiers, general financiers there. When I got to trying to explain deposits to them, I clearly lost them. The idea that deposits could flex as the metal price changed or the diesel price changed because it was in or out of profitability. So a lot of general investors just do not get the fundamental structure of the industry. Just take it as gospel that if somebody tells them there's a deposit there, that's a finite resource, rather like a factory, and it doesn't matter what the metal price is or the costs are.
And I think we saw that in 2011 and 2012 as well. It's very difficult for the industry to sustain the pressure of the generalist investor. When we all want the generalist investors in the space, but when they really jump on their ability to inflate prices and run stock and run things way beyond the ability of companies to then backfill their valuation, you get a very big swing effect at the end. So it's a bit of a double-edged sword.
Mark, from a European perspective?
It's an interesting observation. I suppose 2 points. A couple of years ago, I did a lecture to a group of school children. They were 12 and 13 years old. And I asked them, would you invest in a tobacco company?
Starting a bit over, actually.
Would you invest in a tobacco company? universally, they said, no, of course not. How dare you?
Nor plastic now, of course.
Oh yeah, plastic's bad now. I asked them if they'd invest in a mining company. And a young man said to me, if it was a good investment. And I thought, well, there's hope in this world. There's definitely hope for us. And that, I think, sort of leads on to kind of response to what my two colleagues have said. I think, yes, there's performance is everything, and lots of generalist investors have had bad experiences. I've certainly been berated more than once myself, sitting on the other side of the table saying, we've lost enough money in the industry, basically get out of here. But same token, I wonder how much generalist investors understand about electric vehicles, or about digital technologies, or indeed about cryptocurrencies, or indeed about marijuana. Let's pick all the examples that have been mentioned. So I'm not sure I buy that knowledge gap. What I do buy is the idea that mining companies need to go out, particularly junior mining companies, need to go out and inform. They really need to describe exactly what they do in much more digestible terms to generalist investors. There isn't a tradition in Europe of direct investment by households in mining stocks or in raw material stocks at all. I live next door to a quarry in Sussex. I have another good friend who also lives next door to a quarry in Sussex. Most people I know where I live have absolutely no investment in the mining industry. Why, I say? We're all living next door to these quarries. None of us have grown two heads. Our dogs and cats are all fine. And we're all breathing perfectly clean air. So why not? Good question. So then you can start a conversation. The issue is very simple. Mining companies seem to be relying still upon other people to inform the investment decisions of their target groups. I think we need to change that. If you look at tech companies, if you look at even the financial sector, they're appealing directly to investors on an everyday basis. You can source the information directly. You don't need to go to analysts' reports. You don't need to do very much to get the data you need to make a reasonable investment decision. I think mining companies need to make what they do more intelligible and more digestible, and that has to be the future.
Yeah. Okay. We'll come to the audience questions towards the end, but taking all that on board, I think we can agree that on top of all this, politics has become considerably more important this year, thinking particularly, obviously, of President Trump. But equity and metal markets, to my knowledge, have not been affected to the same extent by politics in recent years. To what extent do you think this is affecting exploration and development activity? Or do you disagree that politics is not affecting mining? No, you have a view, Mark.
Let Ben go first, please.
Jeez. Yeah. Having worked in a couple of places in the world, I'd say there's definitely an influence of politics. I think working in Mexico right now, you're talking to investors. People are very standoffish about biting the bullet and investing in Mexico coming into an election, something like that. People are a lot more focused on the geopolitics, especially when there's a lot of rhetoric going on among political candidates, and there's uncertainty, and uncertainty always generates risk. Having come from and worked in West Africa, where we saw commodity taxes and royalties be adjusted while we're working in country. I was in Burkina for 3 coups. Politics and geopolitics are really important. At the same time, though, it was interesting because although they make a lot of noise, and this is true of the coup in Mali as well, there's a case study on Randgold and how Randgold's production was not affected during the whole coup in Mali, and nothing actually really changed for them. It's the perception of the politics and the perception of the risk that becomes something that's very difficult for shareholders and investors to deal with. I think there is work to be done by the mining industry to engage more with and to educate governments more about how the mining sector works, the same way that Mark was just describing. The need to engage with investors on a more simple level is that you see it all the time when commodity prices are doing well and companies are doing well. Governments think that that's the right time to change to move the hurdles or to change the investment criteria or the way in which companies are paid or get money out, recycle their money. But it often, with the cyclical nature of the industry, it hurts way more, and it hurts the governments and the people on the downside. So. that goes further, I'll hand over to Mark. But I think, yes, it does have an impact, and it is an important consideration.
Mark's probably not got a view on this, have you?
No, I could talk about this all day.
So you sounded way more qualified to answer this question.
Look, I think there are lots of ways of approaching it. I think one, if we take the process all the way to the other end, if you look at export restrictions in the world today for raw materials, we're talking about hundreds of restrictions. I think it's 465 today of notable commodities, things you would be interested in as a government, as an investor, as an industrial consumer. You know, the last, I think, was 262 have been added since 2016. These are very telling statistics. We hear a lot of words like resource nationalism. We hear about nativism in politics. These are essentially barriers to entry, barriers to business, and barriers to exploration. So how do you overcome this? To another extent, what is the other side of it? The other side of it is, we see it from China. We see government support for exploration both within the country and abroad. So Chinese acquisition of assets, I don't need to elaborate on to an audience like this. But you also see support from other governments elsewhere. You see governments in, for example, Scandinavia, supporting exploration work, still today. So looking forward, we need to see greater investment in terms of intellectual capacity, greater investment in terms of linking exploration's role in security of supply in that political debate. And yes, we do need to inform it. I think, to be fair to most Western countries, there is an increased awareness of that. Certainly speaking in terms of the countries that we work with, and as you remind, we work not only with the European Union, we've just done a project with the Canadian government, we're still working on a project with a group of Latin American countries, we're in a dialogue with the United States and Japan and others, the African Union. I have a long list. There is an increased awareness that if we are going to provide for the supply we need in the future, we need to understand exploration better, we need to invest in it better, and we need to protect it better. I think it becomes a question of husbandry of resources, and I think we haven't really focused on it. You know, we look at, I waved this piece of paper around before, but there's too much focus on too small a suite of materials. It's very easy to understand certain metal markets, for example. What we're not very good at is understanding the markets that we need in the future. People generically talk about rare earths, but what we're really talking about is a particular suites of rare earths. Yes, one can have a long conversation about where the electric vehicle market is going and what will be needed. But unless somehow miraculously, and I do not believe this myself, unless somehow miraculously we can impose a circular economy to a far more effective way than we are today, I don't believe it. I see no alternative but for greater political support and government investment in exploration. And to be fair to the Europeans, they're doing it.
While you've got the floor, Mark, many of you will probably have seen it a month ago, almost exactly, the European Union unveiled a new sustainable finance initiative. This is a trend that's undoubtedly going to affect supply chains, customers and companies, as well as their investors. Mark, do you want to kindly explain it to us?
This is work in progress. It echoes work that's been, I think, exemplified by the LBMA and the World Gold Council in terms of responsible sourcing, and this concept of sustainable finance. Now, many people refer back to the United Nations Sustainable Development Goals. There is no sustainable development goal for mining or raw materials. It is woven into all of the sustainable development goals. So this begins to cause me a problem because it starts to get a bit vague. We have this idea of greenwashing, the idea of somehow where you invest your money should be somehow ethically acceptable or not cause any problems with your compliance department, perhaps. Sorry for being a little sarcastic. But there is this general wish among the investment community that there is greater sustainability, there's greater accountability, there's greater, if you like, moral compass about where your investment portfolio is going. This is seeping into investment into our industry, not only in terms of the investment community, but also in terms of our supply chains and our customers. In terms of our customers, I actually think this is a great positive because I think absolutely everybody in this room have standards of corporate behavior and governance, which I think will hold to any reasonable standard. In 2014, was it 2014? Yes, 2014, it was Greece had the presidency of the European Union, and I went to an industrial technology conference. It was very interesting. A lot of our customers were there, particularly people from the digital sector, from the technological sector. And I posed a question to one of these groups saying, is sustainability important? Is supply chain authenticity and verifiability important? Are ethical standards important? No, 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 no. Price was the only issue that actually mattered. Completely straightforward about it. That's not the case today. The European Union is working on legislation now, which is due to come out quite quickly, that will change the way that, for example, mobile phones are going to be recycled. At the moment, it's not economic to recycle a mobile phone. It's welded together in such a way that it doesn't make any sense to take it apart in Europe. Moving forward, that is going to change. You are going to be able to take your mobile phones apart and recycle them in Europe. Why is that important? Because it creates transparency to the supply chain. The European Union, therefore, in tandem with that and other things, has launched a sustainable finance initiative. That means essentially that only projects that meet standards of sustainable behavior and environmental stewardship can be supported in the European Union. This sounds nice. It has lots of pitfalls. It's a road that seems to have some bends and potholes. But my point in raising it to you today is that it is at the consultative phase. There's going to be what's called sector classification. So different sectors will be treated in different ways. It will affect all of you. So I strongly suggest that you either get in touch with us or with your relevant industry body to contribute to that debate. There has been some good contributions. I'm going to a workshop tomorrow in Brussels about it. But I urge you, please get involved in this debate. Otherwise, you'll be responding to a set of criteria that you may not find palatable.
I think that leads on to another interesting thing. I've often mulled, as I think you know, Mark, that there's a real dichotomy in mining that, as everyone I'm sure is aware, a director's fiduciary duty, certainly in most market economies, is to their shareholders, first and foremost. And in the capitalist system, you almost always value a project on its net present value or something similar. And that invariably is fairly large, quick operations, in and out relatively quickly. You're not about to build towns and hospitals, and a 5-year gold mine is perhaps the optimum. The problem is for communities, particularly in Africa and Asia, they're looking for smaller mines that last longer, and they can build up a community. And you can start putting in hospitals and schools and the like. And I'm just not sure that the industry's structured to start thinking about, I'll have half a size mine lasting twice as long, even though that's better for a lot of the stakeholders. And a bit like some of the other issues we've addressed, I'm just not sure anyone's even thinking about that, and I'm just not sure how you square it. And I don't think I'm expecting an answer from either of you, but do you think that's an issue, or is this something that, because we're talking about social acceptability. Well, most stakeholders would say, I'd like a small mine that's going to be there for my kids as well, so they can have a long-term jobs, rather than the 5-year fly-in, fly-out operation, which might be more profitable.
It's a difficult one to answer. I mean, there's different levels of stakeholders, right? There's the people that are providing the capital to build these projects, and they obviously, especially if you're talking about a fly-in, fly-out job, there's typically a lot of risk involved in that, so you want to see your capital return to you as quickly as possible. So from a financier's perspective, a mine needs to be put into operation as quickly as possible and return capital as quickly as possible, and then maintain profitability for as long as possible. And that's where I think you sometimes get into conflict between what's best for the community and what the community wants versus what the reality of, if you want to have this mine here, it is high-risk capital that needs to be returned. And I think we see that play out constantly on projects. And I think, I don't want to say that this is something that the industry does badly, but I think it's good to see more and more dialogue about this, and it's something that's very much present in what we do at Exelon, is talking more about how we engage with government, how we engage with all levels of community, all our stakeholders, how we understand who they are, what their needs are, and listen, as opposed to just trying to make decisions on their behalf as to what we think is better for stakeholders. And then try and put those two together, because they will sometimes be at odds as what your financiers and what your shareholders want, and what's better for your social license, your ability to incorporate within a community, your ability to operate sustainably, which is, I think, a word in inverted commas here, but to work within that community. And the other thing that I think the industry needs to look at more and talk about, if you go back to somewhere like Obuasi, a place that I worked around extensively in West Africa, there's nothing going on there. A lot of the mines and the legendary Obuasi mine has been shut down. There's very little work going on there. There was tens of thousands of workers there that are still sitting there waiting for that mine to reopen. A lot of the low-level skills and the availability of that human capital and manpower were not relocated to somewhere else where they could be deployed strategically again. And then if you did that, then you have to think about all the impacts of that, the social, the moving families and stuff around. So just think, resources are where they are, and it's very difficult to get an optimal situation in which everybody will be happy, but there needs to be balance.
In Europe?
I think it's an interesting question. I'm looking at, there's a young lady from EBRD over here, and there's Jamie Lesser sitting on the other side of the aisle, both of whom would be tremendous contributors to this discussion. I'm not putting you on the spot, but my point is that there's excellent work being done on this, both by multilateral and international organizations and by smaller groups. I think yes, we do need to work with governments, but we do need to work with stakeholders. I think you're right. I think it's identifying stakeholders, and they're never the same group in each project. I could point to lots of good examples. There are numerous operations in Scandinavia, Kiruna, Kittilä, Aitik, Garpenberg, Zingravan. All of these are long-term operations that have been very successful and have gone through generations and will continue to go on for the foreseeable future. So we have lots of good examples in Europe about how this can be done. The question is, how do we export these models in a sympathetic and successful way? There are lots of good examples in Latin America as well, not so many good examples in Africa. So I think working with other groups, OECD are doing some excellent work on this. But I strongly recommend you go and talk to Tatiana from EBRD and Jamie Lesser, who's sitting over there, who's got a nice beard and an open-necked shirt. And both of them will give you very good ideas on how to do this.
I was just going to say, perhaps at this point I won't ask any more questions and we'll have them from the floor. Did you have a microphone?
You're calling for maximizing payback, IRR, get things lower risk, not so big a capital cost. So maybe that first mine's not going to be so big. And maybe that means it's going to be a longer tenure. So I think there might be more of an alignment with stakeholders.
There's also the issue, and there's far better experts in the audience than me, of presumably governments, rather than giving the go-ahead on one mine, waiting until there's a cluster of 3 mines, and then the 3 mines together can afford the railway line or the hospital or whatever. I won't ask any more questions because I've done my share. So is the microphone right at the back? It doesn't have to be a question, incidentally. It can be a comment.
We do owe a question to the front of the room here because I know you missed it earlier.
Earlier today, Rick Roll was talking about the amount of money in the 40 years that he's been in the industry that has been lost. And a lot of that money, admittedly, has gone into bad M&A, but a lot of it's gone into reasonably bad exploration. I think he said there's a 1 in 3,000 chance of a greenfield exploration thing turning into a mine one day. And I think that one of the reasons we're lacking investment in the sector is because exploration just hasn't returned a great deal of value. What do you think? Do you think there is a way, or do you think the industry needs to find a way? I mean, given that exploration returns less and less value per dollar invested the way we're doing it today, how do you think that changes? And do you think that without changing, we can get any investment in it?
I think you're solely talking in terms of Anglo-Saxon equity markets, the answer is you make a very good point, and we need to change the model. And it may be that we need to take a more mixed model. Some people would look, and this is a debate, I have no firm opinion. Some people would say you need more state intervention. Some people would say that you need to create new vehicles that are willing to take these type of risks and have some sort of fiscal benefit attached to that activity. But if you look at different models outside of the Anglo-Saxon world, you know, if you look at some of the mining statistics, I made reference to that Austrian study that came out earlier, and also the work that's being done by the Joint Research Council in the European Union. If you look at the vast majority of exploration activity, it isn't for the sexy things that we talk about. It is for the boring things that reflect the fact that urbanization is going to rise massively in the next 30 years. And that exploration does pay back, frankly, in terms of absolute numbers, it does. But unfortunately, that is not manifested in equity markets. So perhaps I do take a different perspective. I agree with you. I think there does need to be change.
Mr. White?
Yeah, I think the central issue of this conference is about mines and how we're going to replace reserves. Geopolitics has kind of confused things. As Ben says, if you're in country and it's not affected as it was in Mali, we shouldn't be overly concerned. In 2002, Chris Hind and I founded Mines and Money because there was a disconnect between exploration and finance because of the scandal a couple of years previously of BRIEX. The rise of social media and the proliferation of regional conferences rather than global conferences has not given the confidence yet to the investing community to fund exploration. Mining Journal did the World Risk Report, which is the first international report where risk is being evaluated. The role, as I see it going forward, is that we, through Mining Journal, I'm not a director, but we through Mining Journal should bring together organisations like the World Gold Council, the EBRD, international organisations like Mark's talking about, to provide a platform which can change the perception of risk in mining and exploration. Because what Ben's looking at, he's looking at a great need to replace reserves. What Gerard Reed and Gianni Kovacevic are looking at is they are seeing a revolution that has to be funded by a lot of copper and a lot of nickel and a lot of lithium being provided. We do not have the projects in the pipeline now because the financial community internationally has lost confidence in mining. And a lot of that's due to the enormous growth of regulatory mechanisms. I'm sorry, I am inclined to make a speech and I'm not on the platform, but...
We've only got a minute left. Final question that requires a quick answer. In that case, I'll ask the last question that needs one-word answers. Which commodities and or countries best targets for exploration? And you can't state ones you're already investing in, Ben.
I saw a very interesting stat the other day that's kind of been rolling through my mind that it actually answers your question. Oh, you wanted a one-word answer for this. I'd say the US.
Really? That stunned the audience. Yes. Somewhere in Europe, presumably, Mark.
No, I would say rare earths and I would say Scandinavia.
Okay, thanks. That's it. We've got half a minute to give back to the conference. Please thank our panellists. Thank you very much.